Welcome to Quilter Cheviot's Market Uncut podcast, your weekly insight into the topics and issues that we've been discussing here at Quilter Cheviot. I'm Oli Creasey, Head of Property Research in London, and I'm joined as always by regular commentator and Head of Fixed Interest Research, Richard Carter. Hello again, Richard.
Hi, Oli.
All right, so I'll just jump straight into it, to be honest with you. I've been looking at the recent economic releases, and it feels as though we're in a bit of a news vacuum, if anything. There is a bit of data out there, and I guess we'll come to that in a second. In terms of volume, it's been pretty light, and the corporate news has been the same story. I guess it's time of year thing, but we're still in the so-called silly season politically, would you say? Have Angela Rayner's personal finances been under additional scrutiny because there's nothing else for us to talk about?
I think if we were in silly season, we're about to come out of it, and some important stuff coming up. I think also Angela Rayner, very important figure in the Labour Party. Keir Starmer's under pressure, obviously, with Reform doing well in the polls. So I think it was a big deal. I think for markets, key thing is that Rachel Reeves is still in place. So that the reshuffle was quite wide-ranging, but it kept Rachel Reeves there. So for markets, it probably wasn't such a big deal. But clearly, the pressure's on ahead of the budget.
Yeah, indeed. We will look forward to that budget, I'm sure. So I was looking back over the last week, and the most interesting data seemed to be that coming from the US. So we had, I'm going to read out the list here, manufacturing and service PMIs, the now famous JOLTS, and the non-farm payrolls. And it looked to me, as a non-expert, that they all came in a little bit light by the look of it. Is that in line with your understanding? Does this further enhance the prospect for a September rate cut? I'm going to add a bonus question as well, because I've seen a few people whispering about 50 basis points. Are we going to put that on the cards, or is that too much for now?
I think it's too much for now, but markets love a bit of speculation about that sort of stuff. I mean, last week the big one standout again. Weak non-farm payrolls. Fed's very sensitive to that sort of thing. We've now had, rather than just one bad number, a string of bad numbers. So while inflation is still a concern, it's for sure that the labour market's weakening. So that means we'll get a rate cut next week from the Fed. And they've got 2 more meetings after that by year end. So potentially we could get 3 rate cuts by the end of the year. Donald Trump will be delighted, but inflation is still a concern, which is why I say I don't think we'll get a 50 next week.
Yeah, and you mentioned Donald Trump because, I can't help but talk about him, I'm afraid, and a lot of people are the same. He has been very clear and consistent on one thing, which is that he wants interest rates to come down quicker than the current trajectory or the recent trajectory has been. I kind of wanted to pick your brain. Do you have any feeling on what exactly he's why he is that way about this? I kind of had always assumed that it was a cost of borrowing thing and helping with the deficit that way. Though I was listening to you last week, and it sounds like it might not be quite as simple as that in terms of the relationship between those various factors. Do you have any theories on what his obsession about this is, and what he might be doing with the Fed governorship and so on?
I think it's because he's a real estate guy. I think he likes lower interest rates, and he's probably been through enough bankruptcies because of high interest rates in the past that he's just default setting is to like low interest rates. I mean, it's right. If you like you say, if they're cutting interest rates at a time when inflation's a problem, that's not necessarily going to help their cost of borrowing. The front end of the market yields will come down. Longer dated won't do so well. So there's a bit more to that. I also think he's probably worried at the back of his mind that they've done all his tariffs and stuff, and if that coincides or causes a big recession, job losses, he'll get the blame for that, and his popularity will sink. So I think maybe he just wants the Fed to help him out by cutting rates so the economy kind of comes through it smoothly.
Yeah, I as a fellow real estate guy, and I never thought I'd have anything in common with Donald Trump, I can confirm that we do fixate on lower rates. We'll move on. The Fed cut in September seems pretty locked in. Seems like another sure thing is the collapse of the government in France. Though for the listeners' benefit, that vote is happening sort of later today as we record this, I dare say the outcome will be known by the time we publish. So we're sort of operating in a bit of a knowledge limbo there, but it does sound like the Prime Minister isn't going to survive the vote of no confidence there. How important is that for the French economy, and I suppose also for Macron's presidency more generally?
I think it is important, although you've had this going on for a while, and sort of the French economy sort of trundles along, and people get on with life, and the government taxes and spends and everything. So there hasn't sort of come to a crisis moment like it did in the UK with Liz Truss or anything like that. It's just that markets are a bit jittery. French borrowing costs have gone up, but it's not really a crisis moment. But clearly, uncertainty and political uncertainty is not good for economic growth, as we know. I think probably they'll appoint another prime minister who will have the same problems that the current one faces, and we'll be back here in another 6 months or a year in exactly the same situation. But I think markets would be obviously extremely worried if Macron were to stand down himself, and then you have a presidential election with all the risks that brings. But I don't think that's very likely. Chances are we'll either have a new prime minister with the same problems, or new elections, which will probably get the same result. So I think we'll just stumble on in France for the time being, and hope they come up with a solution in the end.
Yeah, good luck to them on that one. So looking ahead now, putting aside that French vote, it looks like there's a fairly quiet week coming up. Again, there are a few things going on, and I think the ECB rate decision, which is on Wednesday or Thursday, you'll have to remind me, that'll perhaps be an interesting one. That being said, it sounds like a hold is the most likely outcome, and the probability of a surprise fairly low. So any thoughts on that, I suppose, and what else are you keeping a close eye on this week?
Yeah, that's on Thursday. We had a long run of rate cuts from ECB. That's now over. They're down to 2%, and the economy's doing all right. So there's no real reason for them to do any more rate cuts for the time being. So that probably won't be that momentous. We've also got US inflation numbers out on Thursday as well. So although we think, the Fed rate cut's definitely going to happen, if you've got a really bad inflation number, and I mean bad by high, that might cause a few jitters ahead of the meeting. I mean, this is the real worry for bond markets, that you get sort of slower growth and certainly on the job side, but at the same time inflation picks up because of the tariffs, and what does the Fed do, and what is it, and Trump's going to be pushing for more rate cuts at that time. So that's a bit of a dangerous mix potentially. So those numbers will, I think, be pretty closely watched.
Brilliant, thank you. So we also have a date for the next UK budget, 26th of November. You did mention that at the beginning of all of this. There's already been quite a lot of speculation as to what's going to be in that budget, despite it probably not all being written yet. So I suppose this is your opportunity now, Richard, to speculate wildly as to what changes we might be facing. I was going to promise not to come back and fact check you on the 27th of November, but we'll see. Let's see how wild you go with your speculation.
Well, I think, there'll be various stories leaked to the press for the next 2 months with tedious predictability, most of which will never come to pass, I suspect. I think one thing they're going to do is get rid of this sort of 2 forecasts a year where we obsess about headroom for 6 months, and then worry about what the Chancellor may need to do to get back to enough headroom to meet the rules. I think the IMF has been saying just do it once a year, and that probably would be a good thing to do. The other thing is, everyone's talking about tax rises. I mean, I would hope they've learned their lesson a little bit from last time, that putting taxes up just leads to a slower economy, which leads you back to exactly the same problems with your debt as you had anyway. So I think probably these tax rises and maybe spending cuts will be sort of pushed out gradually over the next few years, in the hope that things turn for the better on the economy, and they can sort of scrap them or water them down at a later stage. So I'm hoping it won't be as dramatic or severe as people maybe are thinking. And I think Rachel Reeves is under quite a lot of pressure to make sure this is a successful one. So, but I always think budgets turn out to be less bad than people were expecting. Let's hope that's the case again.
What do they say? Under promise, over deliver, perhaps. That's the theme here. Thank you, Richard. So look, I think we're getting to the end of the agenda, but I think there is time for a shameless plug. But I think it's worth doing. I know that Richard and team have worked really hard and have put together a rather comprehensive document, which I think is available on the website already, Richard. If not, will be very soon. Titled "Gilt Markets: Crisis or Opportunity?" ? So I appreciate you want to avoid spoilers, Richard, but well, which one is it?
It's probably a bit of both. I do think there's been some massively overblown theories that the IMF's about to bail the UK out, which is obviously complete nonsense. Should I put it that way? I don't think the IMF's in the business of bailing out countries like the UK anyway. You'd have to get the Bank of England to help you out probably, but. There's certainly problems in the UK, but I think the government's generally trying to do the right thing. And in fact, a lot of what's been happening is, in terms of longer dated bond yields rising, has been going on in lots of countries as well. So it's not just a UK thing. And it was interesting last week, bit of weak US data, suddenly bond markets back in demand, yields falling, everyone rushing to buy at these very attractive levels. And I think you've got sort of long-term bond yields of over 5.5%, with inflation between 3 and 4. That looks pretty good. So we think it's an opportunity, but albeit, we recognise that there are several countries, including the UK, who've really got to get their fiscal house in order as best they can.
Thanks, Richard. And in all seriousness, it is not, well, it is a plug, and it is a bit shameless, but it is an excellent article. I have read it, and I think it's well worth a read. So I would encourage all of our listeners, if you have the time and inclination, to go to the QC website, where it should be pretty easy to find. So look, thank you, Richard. I'll bring this to a close, but thank you as always. Excellent insights there, and very valuable to us all. So I did mention the website, so I would send all of our listeners there if they haven't been already, if they haven't come from there. But you can stay up to date with our thoughts on markets. www.quiltachieveit.com if you don't already have that in your favorites bar. You can also see past webinars, subscribe to this weekly comment podcast and newsletter, and please do that because we do love having interaction where we can. And speaking of interaction, if any of the listeners have got any questions or any topics that they would like us to address, do please submit those questions via the weekly comments page on that website. And I say this every time, but we do like reading those questions, and it does help inform some of our discussions. So do please submit them. We'll be back as always next week. And in the meantime, keep up to date with us on social media. I'm sure you already know where to find us on Facebook, Instagram, Twitter, and LinkedIn as well. We shouldn't call it Twitter anymore, I suppose, but all the regular social media pages there. So I will close now. Thank you once again to Richard. Thank you to the rest of the team who support this podcast. And of course, to everyone for listening. Bye for now.